Welcome back to Salted Hash. I'm Juliette Beauchamp. I'm here with J.M. Porup, and today we are going to be discussing cybersecurity insurance. This episode of Salted Hash is sponsored by Veracode. The company's latest State of Software Security report finds software security is still a challenge at organizations around the world. Find out why fix rates for application vulnerabilities are still lagging and what CISOs can do to improve their software risk posture in Veracode's new podcast series, which can be found at the address below. So, JM, cybersecurity insurance, pretty hot topic as of late. I mean, it seems like there's so many ways that you can protect yourself against a hack, but in case that hack happens, cybersecurity insurance is really important.
Yeah, cybersecurity insurance is a still growing part of the security landscape. And on the one hand, it has the potential to provide financial incentives to enterprises to improve their security game across the board. And for enterprises, transferring some risk is usually seen as a good risk management move. The other side, the downside of cybersecurity insurance is that it is still early days yet, and there's a little bit of growing pains in the industry and some concerns that cybersecurity insurance, as it's currently being bought and sold, is creating maybe perverse incentives to not always do the right thing.
Yeah, there is definitely that debate within the security community about whether cyber insurance will actually incentivize these good security practices. Can you go into a little bit more depth about why, not everyone's sure that having cybersecurity insurance will actually make businesses want to do good?
Sure. Well. So there's, insurance is centuries old, from the days of sale, and the concept of insurance is a well-developed sort of, business strategy. It's in no way new. And one of the key components that all insurance companies grapple with is the so-called moral hazard of insurance. The idea that if you transfer too much risk or all the risk, then that creates perverse incentives that result in bad outcomes. For instance, if I have fire insurance on my house and I don't install fire alarms and I negligently, leave candles all over my house and my house burns down because I engaged in gross negligence, an insurance company is going to say, well, we offered fire insurance, but you burned your house down. We're not going to pay out if you burn your house down or if you engage in gross negligence that results in your house burning down. This is why we have deductibles and also capped payouts on most insurance plans. The idea that you can transfer some of the risk, but you have to assume some of the risk yourself. That it's a shared risk between the insured and the insurance company. And when we talk about cybersecurity insurance, the question is it cheaper? If you're a purely profit-motivated CEO, it would be economically reasonable to say, is it cheaper to pay a small amount of money for an insurance policy and not spend money doing the right thing to secure my enterprise on the expectation that an insurance payout would then economically compensate you when a breach happens. And the cost of an insurance policy is often substantially cheaper than doing due diligence. And there's this coming clash between insured enterprises who are looking for a cheap way out of doing the hard work and security, and insurance companies saying, you can transfer some of the risk, but you still have to actually do the hard work of doing good security.
Absolutely. And I mean, to me, it would almost seem intuitive that a business would want to practice good security, because obviously there would be a monetary loss, but not to even to mention the loss to your reputation, the business's reputation, the CEO's reputation. And on top of that, it just seems like the right thing to do. Is that just too optimistic to think that businesses are just, they want to secure their enterprise because it's the right thing to do?
Call me a professional cynic. If we look at similar cases, such as if we look at the development of environmental protection laws, the 1960s perhaps, it is economically profitable to dump toxic waste into fresh water, causing cancer for large portions of the population, than it is to actually properly dispose of your toxic waste. And many companies in the 60s deliberately did so until the government stepped in and said, it is not in the public interest for for-profit companies to be dumping toxic waste into fresh water. Like, this is bad for society. This is bad for everybody. It may be profitable. It may be economically good for the corporation. But as a society, we cannot tolerate this kind of corporate conduct. And I feel like we may be in a similar situation today. If we look at the Equifax breach, Equifax suffered a major breach. I've had numerous security experts call it gross negligence. Like, in their opinion, Equifax full-on committed gross negligence. They got breached. Pretty much every adult in the United States was economically harmed as a result. Equifax's security insurance paid out on the order of like $100 million. Their share price rebounded in a couple of months. Their CEO quit with a golden parachute. There's been no real regulatory punishment. There's been no market punishment. And a big part of this is beyond the failure of the government to regulate in the public interest, there's also the fact that in many of these, specifically breaches, the customer is not you and I. Equifax's customer isn't you and me. It's the people who give Equifax money. It's the banks. It's the people who want to see your credit score and my credit score. And as far as those customers are concerned, they are not harmed by disclosure of our personal information. And so you have this sort of grave social harm with very misguided economic and regulatory incentives producing bad outcomes for society as a whole. And the people I've spoken to are comfortable saying some combination of better regulation and insurance-based financial incentives is probably the right way to get where we want to be, which is where companies do the right thing, not only for their bottom line, but for the good of society as a whole.
Yeah, absolutely. So what kind of requirements do cyber insurance policies place on companies to minimize the risk of losses from these attacks? Equifax got, like you said, millions and millions of dollars, and eventually, correct me if I'm wrong, posted a profit because of these payouts. How do other cyber insurance policies minimize that risk of having to pay out so much and, going broke?
That's a great question. So let's take a common sense example that I think everybody can understand, which is car insurance. If you buy a red Ferrari, you're going to be paying a lot more in insurance because the kind of person who buys a small, red, fast, expensive sports car is more likely, actuarially speaking, to be involved in some kind of accident than someone who buys like a 10-year-old Volvo. This is a sort of risk profile that we can all kind of understand. And insurance companies will reward good drivers. Like if you don't have a ticket or any kind of driving violation for 10 years, your car insurance is going to be lower. Whereas every time you get a speeding violation, your insurance is going to go up because you are now perceived as being a higher risk driver to insure. So insureds who engage in reckless conduct pay more for insurance because they're more likely to require insurance payout, and people who are more cautious and do their due diligence and drive safely pay less for insurance. And I think that I think pretty much everyone in the cybersecurity insurance business would like to see us live in that kind of world. That companies that do their due diligence in terms of security are, in fact, financially rewarded with lower premiums. I think if you asked anyone in cybersecurity insurance today, they'd be like, that's the world we want to live in. We want to offer low premiums to secure companies and high premiums to insecure companies. Like, that's Insurance 101. But the problem is that that's not yet the world where we are today. Historically, cybersecurity insurance was sell the policy now and worry about any fallout later, just to grow the market, because this is brand new. 15 years ago, this cybersecurity insurance basically didn't exist. So insurance companies are really about gathering enough information to have sufficient data to perform solid actuarial science, to be able to even understand. I mean, this is not an easy problem. If you're an insurance company, how do you say this company is a good risk and this company is a bad risk? That is not a fully solved problem. Mm-hmm. Historically, insurance companies have worked on questionnaires. They would send you a 5-page questionnaire, and they'd ask really basic questions like, what sector are you in? Do you use encryption? What kind of technology do you deploy? And this very crude, rudimentary calculus would arrive at almost throwing a dart at a bullseye kind of score. And today we're seeing a move to more quantitative measurement in terms of many insurance companies will scan the entire IPv4 address range, and then every week, and then sort of map the external-facing security posture of both insureds and potential insureds as a way to bring a less qualitative approach to measuring risk. Mm-hmm. But even still, it remains more art than science, and that is a problem going forward.
Yeah, absolutely. It doesn't seem like there's clear outlines for the companies that write these policies to follow. So you mentioned those sort of rudimentary basics of security, encryption. What are some other steps that companies could take to secure their enterprise to, in a perfect insurance market, have those lower premiums and be, a good risk to take for an insurance company?
Well, I mean, at this point, an enterprise should be talking to their insurance broker or to the insurance company themselves. And it really needs to be emphasized that these kind of policies, everything is negotiable. That's a key takeaway for viewers today. If you are an enterprise looking to sign or to negotiate a new cybersecurity insurance policy, understand that everything is negotiable, literally everything. If there are specific things you want or need, then you need to tell your insurance broker, and you need to be very careful of exclusions. If you are not careful with exclusions, you can find yourself without an insurance payout when you really need one.
Mm-hmm. And how do insurance companies ensure that the requirements that are outlined in their policies are met? I mean, I know for car insurance, for example, there's some companies, car insurance companies, that will give you a device to put on your car to, make sure you're not speeding 15 miles per hour over the speed limit. And that's an obvious, clear way to regulate that safety is being met. How, for something like cybersecurity, can these insurance companies regulate that their enterprises are taking necessary steps to be secure?
That's a great question. Most of them aren't. That requires visibility into the internal network of an enterprise. And I've spoken to people who work in the cybersecurity insurance business, and what they want is internal visibility into actual in-house security practices. But basically at this point, almost no insurance companies have that kind of visibility. The best they can do is analyze external-facing security posture because that's visible for all the world to see, including both insurance companies and potential attackers. But convincing enterprises to offer internal visibility into the potentially quite intimate details of how their security is configured is, to the best of my knowledge, not yet a reality, although I expect insurance companies to begin pushing harder for that kind of visibility, to do just as you say. How can we verify you're actually doing the right thing?
Yeah, and that would be really interesting to understand how having that sort of visibility into a company's security, how that in and of itself poses another security risk. Does having too many, hands in make everything less secure? That's a question for you. What do you think?
No. I mean, and it's a valid question. How do you offer an internal view of an enterprise without exposing that to a potential attacker? Mm-hmm. Which also brings us to the question of there's what's called CAT risk, catastrophic risk. Mm-hmm. If you're an insurance company, you don't want to be at risk of the same risks as your insureds. If you are an earthquake insurance company, you're not going to put your headquarters in the San Francisco Bay Area. If you're insuring against hurricanes, you're not going to put your headquarters in Orlando or Miami. It's important for an insurance company to not itself be exposed to the same potentially catastrophic risks as the companies they propose to insure. But the problem is that on the internet, everything is connected. Mm-hmm. And insurance companies, simply by being on the internet, are equally exposed to the same kinds of systemic catastrophic risk as the insured enterprises that they insure. And that is definitely an unsolved problem so far.
Because cyber insurance is relatively new. When do you think it really started to become commonplace for companies to take out cyber insurance policies, or is it not even commonplace?
Historically, this has been originally a U.S.-focused thing. It began with a California data breach law about 15 years ago. The exact year escapes me. And it's slowly increasing in popularity in Europe. The GDPR has seen a big rush of companies looking to get insurance as well. And the focus until recently has been about breach insurance because of the breach notification laws in California and elsewhere. That's beginning to change. Breach insurance is possibly, in my personal opinion, one of the least useful or interesting forms of insurance because of the massive third-party harms. For again, the Equifax example, you and I are the ones who are harmed, but we have no economic impact on Equifax because we're not their customers. Mm-hmm. Whereas things like business continuity insurance, like Lloyd's of London did a huge report earlier this year called Cloud Down, saying, what happens if AWS goes down? Some insane majority of the American economy is based on Amazon Web Services, but if Amazon Cloud went down for 12 hours, 24 hours, 36 hours, we're talking billions of dollars of harm to the economy. And that's a more, again, personal opinion, that seems to me a more realistic kind of insurance, where we're not talking about third-party harms, but actual direct harms to the company being insured itself. So that sort of evolution of cyber insurance from just breach insurance to other kinds of cyber-related insurance will continue to evolve and grow, I predict.
So there aren't a ton of companies that are necessarily taking out these they're not being as proactive. Are they sort of looking towards, worst case scenario with a data breach, or are they being more secure with these more proactive policies?
Well, let's take the example, to contrast the example of Equifax, let's take the example of Maersk, the giant Danish shipping line that was severely harmed by NotPetya. Now, that was not a data breach. Maersk does not have ordinary consumers as customers. They own boats, and the boats move things around the world on oceans, right? So their customers are all major corporations. And NotPetya shut down their ocean-going vessels, shut down their head office for like weeks or months, causing hundreds of millions of dollars of damage, disrupting their business and disrupting the business of their customers. And I think that's the kind of risk that should be more and more on enterprises' minds. It's not just about dealing with compliance issues and assuring against data breaches, but it's going to be more and more about ensuring business continuity and the consequences of these kinds of disruptive attacks. I don't think NotPetya is going to be the last kind of sabotage-focused malware we're ever going to see. It seems like the beginning of a trend, not a one-off incident.
Absolutely. And if we could dive in a little bit to the NotPetya attack, this is, as you said, sort of what you believe is going to be indicative of a larger trend. And the issue with that cyber insurance situation was that the insurer is pretty much refusing to pay out for these damages, correct?
Yeah. So at the time of this shooting, the filming this episode, there was a news that a major Swiss snack food company, which owns Oreo and Nabisco and a bunch of other major brands you've surely heard of, was also severely harmed and had their business disrupted by the NotPetya sabotageware attack, and made a claim of $100 million to their insurance company. And this goes back to what we were talking about before about exclusions, because one of the fundamental principles of insurance from the very beginning is that war is not insurable. There is no way to insure against war. And insurance companies have always, on principle, refused to insure that because there's no way to do that, economically speaking. Terrorism and piracy are insurable, both historically and in the present tense, but war as such is not. And the insurance policy this company had, I forget the name of the company, please help me out, they had a war exclusion in their contract, in their insurance policy, that specifically excluded incidents caused by nation-state attackers that were a hostile or warlike action, I believe was the exact language. And NotPetya was not ransomware. It was not racketeering. It was outright destructive sabotageware with no intention of seeking a ransom. And every indication that we know of suggests that NotPetya was created and deployed by the government of Russia, initially to attack the Ukraine, but it then indiscriminately spread elsewhere, and it was designed to do so, to cause chaos. And so the insurance company is saying, well, this is a hostile or warlike attack by a nation-state actor, and a common sense view of the NotPetya attack confirms that assessment. And naturally, the insured is suing their insurance company, saying, $100 million is a lot of money. We're going to take that one to court and see what happens. But it really should be raising a red flag for enterprises looking for cyber insurance. Everything is negotiable. If you want your company insured against the next NotPetya attack, you need to review your insurance policy for these kinds of exclusions and negotiate that with your insurance company. Or if there is another NotPetya-like attack, you may be hung out to dry with no recourse in the courts.
Absolutely. If this is going to be indicative of a future trend, it would make sense for enterprises to reassess their policies and make sure that they're protected and they don't have these sorts of exclusions. Are there any other sorts of exclusions that are commonplace in cyber insurance policies, or besides just warlike attacks, or is this really the main exclusion?
Well, one thing on a lot of people's minds is sort of, you can call it terrorism, you can call it the gray area between criminal hacking and an actual warlike action. As one source told me, look, insurance, as we consider it today, comes out of the days of sail, when ships went down and you insured your ship coming back home to harbor with, the spices from, the Far East or whatever. And piracy was a serious issue for hundreds of years. So you were insuring not just against, a massive storm sinks your ship with all hands, but also you were insuring against piracy. And while war, as a first principle, is never insurable, piracy and non-nation state warlike attacks generally are considered negotiably insurable. Because a pirate or a terrorist, or whatever word you want to use to label that kind of activity, doesn't have the resources of an actual government and is therefore considered less of a threat. And at a certain scale here, we're also talking about government-backed insurance programs.
Mm-hmm.
Both the UK and the US government, for instance, offer, so you have insurance companies, and then you have reinsurance companies, because insurance companies themselves have insurance,
mm-hmm.
and then the reinsurer sort of insures the other insurance companies. And for certain kinds of insurance, the government itself, with taxpayers' money, will reinsure reinsurers insuring certain things against truly catastrophic events.
Mm-hmm.
For instance, here in Manhattan after 9/11, a whole bunch of insurance companies were like, whoa, we're not going to insure tall buildings in Manhattan anymore. Like, that is not a financially viable thing for us to do. If there's another 9/11, that's just going to destroy our business. We can't do that. Mm-hmm. And the U.S. government was like, hang on a second. Like, we need to have financial insurance for big companies on Wall Street with very tall buildings. So what the U.S. government does, and what the U.K. government has also been doing since the conflict with the IRA during the Troubles, is to say, we will reinsure insurance companies insuring against terrorism. I think as of 2019, the U.S. policy backstop is to $100 billion. Mm-hmm. That's with a B. So in order to make it possible to insure against piracy, terrorism, whatever words you like to use, governments are stepping in and saying, we need to insure against these, and we will make sure, in the interests of society and the economy and stability of the government, that certain of these risks are covered to a certain extent.
Okay. I understand. So even though there is this warlike exclusion does not necessarily relate to terrorism or piracy. I understand what you're saying.
Like if you had I don't know why, but let's say you had some sort of non-governmental group of hackers who decided they wanted to destroy something because I don't know why, mm-hmm. then that would potentially, if it were clearly attributed, be covered under a sort of a terrorism insurance policy. Whereas if the government of Russia or the government of North Korea or what have you says, we're going to hack something and blow it up because I guess we want to, then that would be an act of war, or mm-hmm. even though war wasn't declared, it would still be like, this is a warlike action, even though war hasn't been declared, and therefore not covered. So it gets pretty tricky. And if you're insuring it, for hundreds of millions of dollars, again, have your general counsel talk to your insurance company and talk about those exclusions.
Understood. So the enterprise, when they're looking at their exclusions and maybe reassessing their policies, they should really just be paying attention to these warlike exclusions.
If you're wanting to claim $100 million from your insurance company from NotPetya, you better be sure that your insurance policy is going to cover that.
Okay, got it. So really, just so wrapping up here, JM, there's obviously there's such a wide range of policies and such a wide range of enterprises that are taking steps to secure their companies and others that perhaps are looking just for a payout. So what would it take for cyber insurance to become a consistent and effective means of incentivizing good practice?
That is the billion-dollar question that on everybody's mind.
Almost literally.
No, absolutely. Because, you want a carrot and you want a stick. You want the government regulating to say, you can't do bad things. We're going to fine you if you do. But you also want to have financial incentives to drive innovation. Because regulation does not really drive innovation unless you use the regulation to create a new market on which new companies can compete. So you want the stick, you want the regulation saying, you have to use best practices. You can't commit gross negligence. But you also want to have insurance companies saying, you can save a lot of money if you do the right thing. Mm-hmm. It's that combination of carrot and stick that's really going to compel enterprises to do the right thing, because the right thing is not necessarily the same as what is good for their bottom line. Mm-hmm. And creating a market where it is good for their bottom line makes it easier for profit-driven CEOs to make the right decision and to do the right thing.
How optimistic are you, just anecdotally, that you think, looking at what has happened in the past, that that good business practice will happen?
I think it's not going to happen.
All right. Thank you so much, JM. Thank you all so much for tuning into this episode of Salted Hash with JM Porup, all about cyber insurance. See you next time.